David Blain. A discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain, and we've got a great show in store for you today. We're going to talk a little bit. We've got some what I call stupid news for you to start off with. Talk a little bit about gold maybe. Talk a little bit about the stock market. So we hope you'll stay tuned for the whole show. Our email, if you have any questions or comments, is allthingsmoney@dlblain.com. Our phone number, we encourage you to give us a call. You got comments, questions, a topic you'd like to see on the show, 252-633-0107. And if you can't stay with us for the whole show today, come visit us on the web, www.dlblain.com. There you'll find information about me and my company, as well as archived copies of the show. So today, as I mentioned, we're going to start off with what I call stupid news. I love reading either on the internet or some places that have, like stupid criminal things, the crazy things criminals do, or things like that. So I just could not resist this article. This was came out last Wednesday, November the 10th, by Jonathan Weil of Bloomberg, and the headline is "Stupidest Lawsuit Ever Has Us Suing Ourselves." And he talks about, of all the absurdities to emerge from the bailout of the financial system, here's a new one that's hard to top. The government, through Freddy Mac, is now suing itself. And so here's what happened. He writes, in July, the Internal Revenue Service told Freddy Mac, the congressionally chartered housing financier, that it owed $3 billion in back taxes and penalties for the years 98 through 2005. Rather than pay up, the McLean, Virginia-based company sued the IRS on October 22nd in U.S. tax court to contest its claim. So before Freddy Mac could do that, it had to seek permission from its conservator. Remember, Freddy Mac went bankrupt and had to be bailed out. So its conservator is the Federal Housing Finance Agency, or FHFA. And their mandate is to look out for taxpayers. They consented. And so Freddy Mac disclosed the suit last week. And so here we have a government-sponsored enterprise which depends on financial support to remain solvent. That's Freddy Mac. It's government-sponsored, and it's taken Treasury money from the Treasury to remain solvent. It's suing an arm of the Treasury Department, which is the IRS, which falls under the Treasury Department. So to date, the Treasury has injected about $64 billion into Freddy Mac and collected about $8.4 billion in cash dividends. The Treasury holds a warrant to buy 79.9% of the company's stock. So Freddy Mac can't claim it's protecting its shareholders by taking on the IRS. The company only has to answer to the FHFA. So the details of who did what and who's right and who's wrong are really beside the point. No matter how it turns out, the result more or less should wind up being a wash for the taxpayers. Either Freddy Mac wins and they get to keep more of our money, which the taxpayer owns anyway, or they lose and they pay all that tax to the IRS, which goes to the taxpayers to fund things for the taxpayer. So no offense to my attorney friends out there, but the only people who make money from this litigation are Freddy Mac's outside attorneys, Sherman and Sterling. They're really the only ones that are going to benefit from this. So anyway, I thought that was interesting. Stupidest lawsuit ever, Freddy Mac, which is essentially owned by the Treasury Department, suing the IRS, which is an arm of the Treasury Department. If you got any more of those stories you hear related to finance, not the criminal ones, but related to finance, let us know. We love things like that. Let's start off here. Talk a few minutes about the market. As I left the office to come to the studio, I noticed that the S&P 500, its 1 week return is approaching minus 2%. And if you're a regular watcher or listener to the show, either on cable TV 10 in New Bern or 94.1 FM in New Bern, you will know that we actually had talked about this already, that we fully expected some of the markets to have an interim decline, increased period of volatility. We've been talking about this for several weeks now. So a couple of things. The markets continued advance up until a week or two ago. We saw that earnings surprises, the companies announcing earnings, had largely been positive. Somewhere around 81% of the reports have been positive. What that means is that all these analysts on Wall Street, they predict, say, Coca-Cola is going to earn $1.50 for the quarter. And when Coca-Cola comes in and they announce their earnings, let's say they actually earned $1.60. That's called an earnings surprise, a positive surprise. And that's generally favorable. If most people think they're going to earn a certain amount and they earn more than that, that's favorable. If they earn less than that, that's called a negative earnings surprise. And so we look at, in aggregate, these statistics. And as I just mentioned, in the third quarter, 81% of the reports were positive. 9% were in line. That means that the estimate was right at what the analysts thought it would be. And then only 11% have been negative. And so this positive earnings surprise is market complacency, high optimism on the crowd sentiment. The volatility index has been receding. And so when we were looking for the market to become increasingly volatile. Whenever you have a period of complacency, everything is going very good, actually is the time when you want to be most concerned. And so market volatility we define as apt to be suddenly violent or dangerous, i.e. sharp declines, a changing mood in temper, mood, or desire, which is essentially rising pessimism, and characterized or prone to sudden change, which are intraday reversals. And so these are some of the things that we've been looking for the past few weeks, and it looks like it's beginning to take place. That the market has become more volatile. We've seen a decline of almost 2% in the past week on the S&P 500. So we're going to talk a little bit more about what you can expect from the stock market, what we think, as well as touch on a little bit of gold when we come back. For All Things Money, this is David Blain.